the timescale of the end of the dollar is actually accelerating very, very rapidly. You do not get a government regulator, presumably told by the bigwigs in the Central Committee. You do not get a government regulator turning around and telling the institutions, sell your US treasuries. Now that is quite remarkable. And it's, basically the Americans have made enemies everywhere. And I think there is a growing reluctance to, take their bonds, to subscribe to their bonds, to hold their bonds. If you've entrusted it with the company being a financial institution of some sort, like a bank, then tough. You've got to fight trying to establish your ownership of it. And this is something which has created all sorts of problems in the past. Don't go there. It's a short answer. I think a point which must be made here is that it's not China being sort of overly aggressive against the dollar. She's now in a position where she's got to protect herself. And it's very, very different from, let us say, actually going out and destroying the dollar. Now, her actions are not going to help the dollar, that's for sure. If anything, they'll contribute to the more rapid decline of the dollar in terms of its existence as a fiat currency. But she's got to protect herself. The only thing we don't know yet is at what level is she going to tie the yuan to gold. That's yet to be decided. I think the interesting thing is that because they've got strict exchange controls, this is something where, she could have a gold standard, let us say, for international trade settlement, rather like, Bretton Woods was. It was really sort of an intra-government dealing, as it were. And also, outfits like the IMF and World Bank and so on were able to demand gold out of, in exchange for dollars. So that was the Bretton Woods system. It's very, very limited. You and I didn't get a look in as individuals. But when it comes to the domestic market, I think that because they've got good exchange controls, they could easily put that on, say, a silver standard, which would require the Chinese to have, first of all, a relationship between silver and gold, which is sustainable. So we're going back, I think, to under 20, probably back to somewhere between 12 and 15, something like that, gold to silver ratio. And, I think the other thing is that she needs to have an awful lot of gold and an awful lot of silver. Now, I can tell you from my researches, she's got an awful lot of gold and an awful lot of silver. So, the conditions are in place to do that if she wants to. I personally don't think that's a good long-term solution. But my assumption at this stage is that in common with other governments and other central banks who have been accumulating gold, the last thing they want to do is part with it. And the idea that you offer your citizens the ability to exchange it for your useless paper or your gold substitutes, which hopefully it will become credible gold substitutes, it's not a risk they really want to take. They want to hang on to what they've got because they realize they've got money and they're giving you credit. So, I think in time, if China can get this to stick, then I think they could probably sort of move towards a better standard for the yuan, rather than just, a Bretton Woods Mark II type situation as I've described. Because, the point is, and this is shown in Switzerland, if you have a credible gold standard, then your citizens don't have any gold. They don't need it. You only need gold when you think the system's in danger. So, that's the secret. Have the thing credible. Anyway, we'll see what happens. But it's, I think the point, thank you for mentioning that article I released today. The point about it is that the timescale of the end of the dollar is actually accelerating very, very rapidly. You do not get a government regulator, presumably told by the bigwigs in the Central Committee. You do not get a government regulator turning around and telling the institutions, sell your US treasuries. Now that is quite remarkable.
Modern economies are built on credit, not money. What we're witnessing today is the declining value of credit relative to final settlement assets. Throughout history, every major fiat currency has eventually lost purchasing power and ultimately disappeared. The reason is structural. Governments rely on expanding debt to sustain growth. But growth in this system simply means more credit creation. When debt becomes unproductive and unsustainable, the foundation weakens. Markets may attempt to chart volatility, but this is not a technical cycle, it's a monetary one. The deeper issue is confidence. And once confidence in currency erodes, the consequences accelerate rapidly.
And it's, basically the Americans have made enemies everywhere. And I think there is a growing reluctance to, take their bonds, to subscribe to their bonds, to hold their bonds. And if you look at the market, there's on Treasury, US Treasury tick figures, there's about 44 trillion of foreign money invested in dollars and underlying financial assets. Everything from bank deposits to US T-bills, corporate T-bills, longer maturity bonds, corporate bonds, agency bonds, and roughly half of it is in equities. It's just riding the bull market. Now, we all know what foreigners do when a bull market ends. They just get the hell out of it because they've got no reason to be in your stock. They really haven't. There's no sort of strategic reason or anything like that. Why is your portfolio invested in Afghanistan stocks or whatever? Oh, because they're going up. That's basically the argument. Whether it's Afghanistan or America, it's no damn different. It really is not. They won't realize 22 trillion out of it. I think that I can see that being sold down, and I can see it being really sold down. I don't know. The market is so overvalued because of credit, the credits that's been chased into it, and also very overvalued currently against the yield on the long bond. Probably the highest level of overvaluation seen in history, including the 1929 experience. Now, that being the case, there is a lot of downside in the S&P 500. And on that basis, foreigners, how much can they get out of their 22 trillion? I think they probably walk away with less than 10, a lot less than 10. So, and then what does the US Treasury and the Fed do? Well, the answer basically is they've got to rescue the stock market because we need the confidence, if you like, in the stock market, which will be translated into confidence in the economy. This is the mantra which Greenspan was pushing, 25 years ago.
Mm.
And I think what that means is that along with supporting the banking system, stopping companies going bust, all those zombie companies with unproductive debt, out when it was suppressed at zero or close to, interest rates close and bond yields way down there. Corporate America as well as government America is in a huge, great financial mess. And there are two possible ways out of it. Basically, everybody goes bust. Government stands back and says, right, we're not having any of this. It's your problem. Deal with it. Or what they do is they devalue the dollar through the means of the most massive quantitative easing you have ever seen, which is, if you like, a soft default. Those are the only two options. It's a bit black and white, I'm afraid, at this stage. You can't do a bit of some and a bit of the other.
Absolutely. So if you need a high quality liquid asset, you need something you can collateralize, you need something that you can hedge, you can use as collateral. So if you're not going to have a US Treasury bond, what's your other alternative? There is only one that I can think of.
I would question the need for collateral. Yes, if you're a bank, yeah.
History provides sobering examples. During the early 1920s, the collapse of Germany's Reichsmark demonstrated how even experienced policymakers can fail to contain currency destruction. Economic thinkers like Ludwig von Mises warned that inflation becomes terminal when citizens realize prices aren't rising, currency is falling. Later scholars such as Friedrich Hayek described how monetary instability can fuel political extremism. When economic pain intensifies, societies often demand strong leadership. Currency collapse, therefore, is not merely financial, it reshapes political systems. These historical patterns suggest today's debt-driven pressures could carry consequences far beyond markets alone.
If, on the other hand, you are an individual trying to protect your wealth, you want to have physical possession of your gold and no one having a lien over it. I mean, it's as simple as that. Banks are dealers in credit. Okay. In fact, because they're dealers in credit, they don't really want to hold any gold at all. It's not their problem. Their problem, that problem is the central banks. The central bank has got to tie the value of credit to gold. Fat chance of that. But, as far as the bank is concerned, they're dealers in credit. They create credit, if you like, to lend to someone and balance it with a deposit and take a spread out of the rate differential. That's their business. But I think for people like, such as the ones I advise, I mean, the answer is quite simple. You just hoard your gold, hoard your silver, sit on it securely out of the banking system. Don't leave it in the banking system, for goodness sake, because if things really do go wrong, it's liable to confiscation. It's liable to, and if a bank goes bust, I mean, the number of times I've seen businesses go bust, and there's a confusion, if you like, in the mind of the administrator or the receiver about the ownership of assets. They will treat it as property of the company, if you like. If you've entrusted it with the company being a financial institution of some sort, like a bank, then tough. You got to fight trying to establish your ownership of it. And this is something which has created all sorts of problems in the past. Don't go there. It's a short answer.
A major shift is unfolding in global finance. China is not attempting to destroy the dollar, but to protect itself from its decline. Institutions connected to the People's Bank of China have steadily increased gold reserves while encouraging reduced reliance on U.S. treasuries. With strict capital controls and a growing commodities corridor, China could theoretically link its currency to gold for international settlement. Such a move would echo elements of the Bretton Woods system, but with tighter control. The critical unknown is timing. Yet signals suggest preparation for a more gold-centered trade architecture.
Yeah, and I think the other thing is that the standard of regulation in China, I think, is without fear or favor. And that's something which we can't really say in our markets. I mean, the LBMA is horribly secretive about what goes on. And when you look at COMEX, I mean, it would appear that COMEX is actually, sort of run by the big banks. I mean, the big banks are free to do this, free to do that, and all the rest of it, which is often in contravention of the rules, and certainly in contravention of the spirit of the rules. It doesn't quite work like that in China. China actually has jumped down, and this is an important point. This week, it has jumped down on, the spoofing, short selling, all this sort of stuff. And is making life for people who don't play by the rules extremely uncomfortable. I wouldn't be surprised if some of them end up in jail, quite frankly. But anyway, that is something we've yet to see. But I mean, the regulatory environment in China, I would say, is streets ahead of us in terms of being, if you like, the user of the market, being able to trust the market.
Western paper markets show structural strain. On exchanges such as COMEX, enormous derivative volumes trade daily against relatively small physical inventories. This leverage works until delivery is demanded. Meanwhile, U.S. financial markets remain heavily supported by credit expansion. The S&P 500 trades at historically elevated valuations relative to bond yields. Foreign capital, estimated in the tens of trillions, has flowed into U.S. assets. But global investors historically exit quickly when confidence fades. Should that reversal occur, policymakers would face two stark choices: allow widespread liquidation or pursue massive monetary expansion.
Well, the assumption basically is, I mean, certainly on COMEX, that, you've got a regulated exchange and therefore positions there are regulated investments and all the rest of it. And when it comes to, LBMA, you've obviously, it's principal to principal, but these are regulated entities, banks, and, and even the hedge funds dealing in there are regulated sort of thing. So they're a bit asleep at the wheel, really. And while they wheel and deal in paper, as you rightly put it, they don't actually understand that the risk is now shifting from the paper being redeemed, if you like, for physical that is not there, and leading to a potential crisis. But one thing that's interesting is that while we can see the silver position, and that's looking pretty dire, I think, as far as the establishment players are concerned in the West, it appears to be different with gold. I mean, if you look at the forecasts of various banks, I mean, not that any of their managed money has much invested in gold or silver, but I mean, they're talking gold up over 6,000, 7,000, whatever it is, by the end of this year or by the end of 27. So that tells me that they've got a net long paper book, I would hasten to add. So they're sort of, they're playing a game of trying to get, stay with it, and are probably succeeding to a degree. Hence, their willingness to make, bullish price forecasts.
A common misconception persists that gold is in a speculative bull market. In reality, gold often reflects currency debasement. In 1933, gold traded at $20.67 per ounce. Today, it trades thousands of dollars higher, not because gold changed, but because the dollar did. This aligns with von Mises' description of the crack-up boom, when people abandon currency for tangible assets. The shift is psychological before it becomes mathematical. Once the public understands that declining purchasing power stems from monetary dilution, capital migrates rapidly. In that environment, gold and silver serve not as trades, but as monetary anchors.
I mean, I think this is something which, of course, nobody really understands within the system. I mean, the dealers and so on and so forth. And I read, commentary from some very, very intelligent guys, in the LBMA and so on and so forth. And they just don't understand that it's not a bull market in gold. It's a bear market in the currency. And of course, that's a completely different thing. So if you understand that, then you understand that the price tomorrow, there's a bit of volatility in it. Well, the price in 3 months' time of gold, the value of gold, is broadly unchanged. What you're doing is not taking a bet on gold, you're taking a bet on the currency. That's the key thing to understand. And when people really understand that, the currencies completely had it. I mean, there is, going back to von Mises, Ludwig von Mises, who went through the Austrian hyperinflation following the First World War. And he was, one of the advisors, if you like, working from sort of just outside the government to help stop it happening. But he said that, when you get to the point that everybody understands that it's not prices rising, but the currency going down, they get the hell out of whatever currency they've got for anything which isn't currency. And that's called the crack-up boom. That will eventually happen. But, we're at the stage, Andy, where nobody actually, or very few of us, actually understand that it's not gold going up, but the currency going down. In other words, it's not prices rising, but the currency going down. And over the next year or two, increasingly people will understand that. And as they understand that, the death knell of the currency is just sort of getting closer and closer and closer, until finally the great unwashed plebeians in the street realize actually the contrary that has been perpetrated on them by their governments with respect to currency.
And that's why, one of the reasons why you walk around with a sovereign, because when someone has that discussion with you, it really settles it very, very quickly. And can you just run through that? Because it's a really simple explanation, and you hold that sovereign up, and then what do you say to people?
Well, I got actually funny. It's quite funny because originally I was doing that with a 100-gram bar. I'd go abroad with it and all the rest of it, but customs kept on picking it up. So I thought, no, sod that. I'm not doing that again.
Yes.
And then I started doing it with a sovereign. But then I lost a sovereign. So I thought, well, bugger that. I'm not going to do that again.
Oh, dear. Yeah.
So I don't carry around a coin with me because I'm just too careless with these things.
But nevertheless, it is a good example, isn't it?
Oh, it is. Absolutely. It's a good illustration. No, I quite agree. And I've got a good friend in John Butler who I think carries a Krug around with him, makes the same point. But I mean, you can tell people. I mean, show them a £10 note instead. And what does it say on it? I promise to pay the bearer £10 on demand, signed by the chief cashier. Now, I know the writing on the notes are getting smaller and smaller, and soon you'll need to get a microscope to see this. But that promise is still there. It is a legal requirement. But what is that payment in £10? It is 10 sovereigns. And I mean, 10 sovereigns. A sovereign now is 900 quid, roughly, give or take.
Yeah.
So 10 is £9,000. So a tenner, if you like, under the gold standard, our old gold standard, pre-war, and also briefly between 1925 and 32, a tenner is represented today by £9,000.
Well, I'm off to Lloyd's Bank to have an argument with them tomorrow.
But it's not just us; it's every other currency. I mean, just look at the dollar. It's gone from 20.67 in 1933 to currently just over 5,000. I mean, as I look at it, it's 5,073. Having a bit higher, and it's going to go quite a lot higher. It's going to go higher because the dollar's going down. It's not gold going up; it's the dollar going down. This is I think, the most important point. The earlier you understand that it's the currency going down and not gold going up, then you are going to be ahead of everybody else in your understanding of what's happening. You need no more than that. That's the important point.
Ultimately, the debate is not about timing markets. It is about preserving purchasing power. Banks operate within the credit system. Individuals do not need to. Physical ownership of precious metals removes counterparty risk. Gold does not generate yield, nor is it designed to outperform equities in a boom. Its purpose is stability when currency systems weaken. As debt levels climb and geopolitical fractures widen, the timeline appears to be accelerating. Whether change arrives gradually or through crisis, history suggests one constant truth. Those who recognize currency decline early position themselves not for speculation, but for protection.